managerial accounting, planning and control, direct labor variances. Now we've looked at the direct labor rate variance. Now let's examine the direct labor efficiency variance. The formula for the efficiency variance compares the actual hours worked, actual direct labor hours worked, with the standard direct labor hours allowed for actual output. So just like our direct materials quantity variance, we compare the actual hours worked with how many hours should have been worked to produce the actual number of completed units. And then we total it out by multiplying that time difference, hours difference, by the standard direct labor rate. And again, that's the labor rate per direct labor hour, not per finished unit. So we remember that the actual number of hours worked was 23,000, and the standard rate was $10 per hour, but we need to remind ourselves of what the standard number of hours per unit was for direct labor. So looking back at our standards data for direct labor, the standard number of hours per unit of product was 0.75. So that's what we'll use in calculating the standard hours allowed. So actual hours worked was 23,000. And then we compare that to the standard hours allowed for actual output. So 3/4 of an hour, 0.75 for each unit. So actual output, 23,000 units. And then we multiply that by the $10 standard labor rate per hour. So again, just doing the math. 23,000 minus 0.75 times 23,000 is 17,250 standard hours allowed. 17,250 standard direct labor hours allowed for actual output. So what are we going to have here? A favorable or an unfavorable labor efficiency variance? We actually worked 23,000 hours. The standard says we should have worked only 17,250 direct labor hours. So this is going to be an unfavorable direct labor efficiency variance. All we need to do now is to put it in terms of dollar cost. So to do that, once again, we multiply times the standard rate of $10 per hour. So difference between 23,000 hours and 17,250 times $10, $57,500 is our direct labor efficiency variance. That's pretty big relative to the numbers that we saw on the flexible budget. So what are some possible causes and who is responsible? Well, as I said earlier, scheduling is the responsibility of production. The production manager is also responsible for supervising the work done and making sure that the work done is completed in a reasonable amount of time. So production is going to be primarily responsible for this one as well. But what if production says, well, you know, that material that cost 25 cents less per pound was inferior, and because it was inferior material, it took my guys more time to do the work, to get the job done. They had to do a lot of rework because of the inferior materials. Then in that case, production may be able to point back at the decision made by purchasing to buy a lower quality material. Again, we ask questions until we get to the answer. Just like CSI, crime scene investigation, we're a cost scene investigation group. Other possible causes of the efficiency variance: a machine breakdown. That if the machines aren't working, then the employees cannot work, but they may still be on the clock. So we're having to pay them, but they're not being productive. And in turn, they may have to work more hours once the machines come back up. Well, who's responsible for making sure the machines are in good running order? Again, the production supervisor is responsible, and may have a maintenance supervisor reporting to them. So that individual would be called upon to explain what happened and explain what that poor maintenance of the equipment cost the company. So as with the other variances, we ask questions. We look to who is generally the responsible party, ask them questions, and their answers then will direct us towards the cause, the ultimate cause, so that we can take corrective action to prevent this from happening again in the future. All right, so the net variance on direct labor, we had a 2,300 favorable variance on the rate, but a 57,500 unfavorable variance on quantity, on efficiency. So that nets out to a $55,200 unfavorable direct labor flexible budget variance. So that too is part of that overall cost of goods sold variance on the flexible budget performance report. Next, we'll take a look at overhead.